Quibi launched with $1.75 billion to redefine how people watch video on their phones. Hollywood backed it with premium content, major actors, and high production budgets. The idea was simple: short episodes designed for mobile consumption. But users didn't stay. Downloads were high, but engagement dropped almost immediately. Content remained expensive, while viewing time stayed low. Within months, the platform began losing momentum. By the end of the year, the service shut down completely. The system entered the market at scale, but something inside it never worked. To understand the failure, the model must be defined clearly at the point of launch. Quibi positioned itself as a mobile-first streaming service offering short-form episodes under 10 minutes. Users paid a monthly subscription for access to professionally produced content designed specifically for smartphones. Unlike traditional platforms, content could not be easily shared, downloaded, or viewed on larger screens at launch. The system removed flexibility in favor of a controlled mobile viewing experience. Revenue depended entirely on subscription growth and sustained user engagement. Content costs remained high, with major productions funded at levels similar to long-form streaming platforms. For example, a single show could cost millions to produce, while revenue per user remained limited to subscription fees. The system worked only if users adopted a new viewing behavior that aligned with its restrictions. Growth was expected to come from aggressive marketing, premium content, and rapid user adoption at launch. The platform secured major partnerships with studios, directors, and high-profile actors to attract attention. Large marketing spend supported visibility across digital and traditional channels. Early downloads increased quickly following launch, driven by curiosity and brand recognition. The model assumed that initial interest would convert into long-term paid subscriptions. However, conversion rates remained lower than expected as users evaluated the product experience. Free alternatives already offered similar short-form content without subscription barriers. User acquisition required continuous spending, increasing the cost per subscriber. The system expanded in visibility, but it did not establish strong user retention. At that stage, the model appeared structured around premium positioning, where premium production quality would justify subscription pricing. Content was released in serialized formats to encourage repeated viewing and ongoing engagement. Revenue projections depended on scaling a large subscriber base, paying monthly fees. Operationally, the platform invested heavily in content creation to maintain a steady pipeline of new releases. However, consumption patterns did not align with expectations, as users did not return consistently after initial use. The short-form format competed directly with free platforms that already dominated mobile attention. Retention remained weak, reducing the lifetime value of each acquired user. The system required sustained engagement to balance high content costs, but engagement did not stabilize. The model appeared complete, but it depended on behavior that was not forming in reality. Early usage data exposed a mismatch between how the product was designed and how users actually consumed mobile video. Viewers preferred flexible access, including the ability to share clips, cast to larger screens, and watch without restrictions. Quibi limited these behaviors, reducing the platform's compatibility with existing habits. At the same time, Content did not differentiate enough to justify switching from free alternatives already integrated into daily routines. User sessions were short and infrequent, lowering overall engagement across the platform. High production costs remained fixed, while active usage failed to scale proportionally. The gap between expected and actual user behavior widened with each new cohort of subscribers. Product decisions began constraining growth rather than enabling it. The fragility was now behavioral, and it directly impacted the sustainability of the system. The breaking point came within months of launch, as external conditions and internal assumptions failed at the same time. The service launched in April 2020, just as global lockdowns reduced mobile on-the-go viewing behavior. Core usage moments the model depended on, commuting and short breaks, declined sharply. At the same time, competing platforms saw increased engagement without requiring new user habits. Subscriber growth slowed while churn increased after trial periods ended. Advertising partnerships underperformed as audience scale remained below expectations. The system reached a point where demand conditions and product design were misaligned simultaneously. Attempts to correct the model began quickly, but each adjustment exposed deeper structural limits. Free trials were extended and pricing options were reconsidered to improve conversion. Product updates introduced limited sharing features, but these arrived after initial user drop-off. Marketing spend continued in an effort to sustain visibility despite weak retention signals. Operational costs remained high due to existing content commitments and production pipelines. User acquisition slowed further as negative feedback reduced organic growth. Leadership explored strategic alternatives, including partnerships and potential sale options. However, the core issue remained unchanged. Engagement was insufficient to support the cost structure. At this stage, the system was attempting to adapt, but it could not reverse its trajectory. By October 2020, Quibi announced it would shut down operations, ending the service just 6 months after launch. Approximately $1.75 billion in capital had been invested without achieving sustainable user adoption. Subscribers lost access to the platform as the service was discontinued and content distribution stopped. Content assets were later sold at a fraction of initial investment, recovering only limited value. The failure did not result from lack of funding, but from misalignment between product design and user behavior. Industry impact was immediate, reinforcing the importance of distribution flexibility and platform compatibility. The assumption that premium short-form content could compete directly with free platforms proved incorrect. Leadership decisions prioritized controlled experience over user preference, limiting adoption. The system did not fail due to execution speed. It failed because the model did not match how users consume content.